What's up, guys? Your agent Tyler Wabrung here, and today I'm going to talk to you guys about what's going on in the current real estate market, what I'm doing to prepare for the uncertainty or the upcoming recession, depression, whatever you want to call it. And then I'm going to talk to you about a couple other things that you should also continue to do because I know there is a lot of fear out there. So with that, let's jump in. All right, guys, so I'm not afraid to admit that this surpassed all my expectations when it came to what they were going to do around interest rates. So if you recall, we're coming off of, the low 2s and 3s of interest rates just a year ago, and now we're almost knocking on 7%. I completely thought that they would keep this in the mid 5 to 6 range to keep things more comfortable increase. However, they've actually induced a shock into the market. And so, hey, we have to adapt and we have to kind of be ready for whatever comes out there. So I want to talk to you guys about how this is impacting my business in hopes that it might just give you some perspective, hopefully some positive perspective that the end of the world's not coming, real estate investing is not dead, and you can still be successful with these factors involved. So first, let's talk about what are the things I'm doing to kind of prepare for the upcoming uncertainty. I am a little bearish in general over the next 12 to 24 months around what we're going to see in terms of the market and what it does to housing. Even with these increased interest rates, it's still a seller's market just due to the very limited supply. However, we are seeing houses starting to stay on the market for much longer, and they're getting offers much closer to asking price. But I do think that will start to slow down and we'll start to get closer to a more healthy market over the next 12 to 24 months. But since we don't really know what the next year or so will look like, and we are kind of preparing, you always want to be prepared for the worst case scenario. So we are preparing for a recession or things to get really ugly in the housing market. So what does that mean? So when considering the worst case scenario of a potential upcoming recession, our first business priority is kind of shifting towards defense. So we primarily buy and hold rental property. We do have an active income side that we'll talk about more in just a minute. But if you're holding rental properties, you first want to think about defense. How can we keep everything we have and not have anything impact our current holdings? So when that comes into play, the first thing we try to do is hoard cash. So cash is king, trying to become more liquid in preparation of a potential downturn. This serves two purposes. If things get bad, we have the liquid funds available to keep our operational costs going. So for us, that looks like 4 to 6 months of our monthly property related expenses. So these are property taxes, mortgage payments. Even though we have income coming in, we're assuming the worst case and we're keeping those expenses 4 to 6 months. If you're just getting started and you're on the lower side, you have 1 to 2 properties, you might want to think about a year's worth of expenses just in case the worst happens. I can't remember who said the famous quote, but if you have money problems and you have money, you don't have a problem. So 2 tenants get kicked out. They put another ban on evictions and people stop paying for 6 months, right? Unlikely scenarios, but if that comes to play and you're sitting on heavy cash reserves, you will not be upset that you had that sitting there. And the second being, if an opportunity presents itself, you are sitting in a heavy cash position and you will be able to take advantage of those opportunities if they should arise. So that's number one for us, is becoming more liquid and hoarding cash. So the second focus for us right now is staying away or avoiding any short-term financing. So we primarily use HELOCs and private money to fund our business and to fund our rentals. And although our goal is to get these private lenders paid back quickly, we always make sure that we agree on a 12-month renewable term if needed. When it comes to HELOCs, we're making sure we're very conservative on how we're underwriting and making sure we can absorb any increases to that adjustable interest rate throughout that HELOC. But as always, I like to pay HELOCs off within a maximum of 12 months. We shoot for 4 to 6 to get those paid back. We're being very cautious on HELOCs right now as a short-term debt instrument. We also would highly recommend not getting into any short-term ARM notes, so adjustable rate mortgages. Make sure those are at least 5 to 10 year ARMs if you are going to get into those. There are some really good ARM products out there right now with pretty decent interest rates, but make sure you are getting those longer term options so that one, you have time to pay that principal down in the worst case scenario, and two, you give the market time to recover and you're not having to come up with funds in the next 12 to 24 months when we do think things could get a little hairy. The third thing we're doing, and this is more on the active income front, so we do some wholesaling, some flipping, things like that, but we're really staying away from any large projects from a complexity standpoint and also from a time standpoint. So things that are going to need lots of permits, things that are going to extend to be a long project, things we have to take all the way down to the studs or do any foundational things. We're just staying away from those right now because we don't want to get into a project with an unknown duration that's, anything beyond 4 to 6 months, because we just truly don't know what the market's going to look like right now. And we want to be conservative in case the worst does come to fruition. So those are the three main focus points that we have in our business right now. So I hope that does add some value. Another thing I do want to make everyone clear on is that you should also, even in a bear market or even when there's blood in the streets and things might get even worse, you want to make sure you're always keeping that eye open for an opportunity. These are when most opportunities come to light, and you want to be prepared to take advantage. So don't turn yourself off completely from real estate. We're continuing to put offers out, continuing to run numbers on properties, but just make sure you're extra conservative and that you're keeping in good relationship with your current lender so that you're staying up to date on what your financing options are. For example, we touch base with our lender every 2 to 3 weeks just so we know what kind of rates we can get, and we're plugging those numbers into our deal analysis. So I hope this does make you a little more optimistic about what's to come. I've heard people over the last 5 years tell me they couldn't wait for the next bear market so they can buy properties for cheap. Well, congratulations, we're coming up upon it. So are you ready? Or are you going to continue to just talk about it until the next bull market comes in and you're going to be wishing you are more prepared during this time? And if you did get any value out of this, a like or subscribe would be greatly appreciated. Free way to support the channel. Just drop that button right over there. And guys, if you are curious how we're analyzing properties right now, check out this video over here. We'll walk through exactly how we analyze our deals. With that, I'm Tyler Wayrung, and we'll catch you next time.